Look, if you're scrolling through your phone right now and you see someone talking about their AI stock portfolio that's up 150% in 6 months, and then you look at your boring dividend portfolio earning a steady 4% yield, I completely understand why you might feel like you're falling behind. You're not alone. Millions of people are feeling exactly this way right now. They're watching AI stocks like Nvidia, Tesla, and various chip manufacturers and semiconductor companies absolutely explode while their dividend stocks, the ones they thought were the responsible, boring, sensible choice, are just sitting there doing the same predictable thing they've always done. And the thing that absolutely nobody is talking about is that this feeling, this deep sense of missing out, is one of the most dangerous psychological traps in modern investing. It's not just making people miserable, it's actually destroying their long-term wealth because they're making decisions based on emotion and FOMO instead of understanding what's actually happening underneath the surface. My name is Ian, and I spend way too much time analyzing the gap between what investors think is happening and what's actually happening with their money. If you're someone who's chosen dividend investing as a strategy, but you're constantly second-guessing yourself because of the AI hype, or if you're just curious about why some people are winning big while others are building wealth slowly and quietly, make sure you hit that subscribe button because we're going to demolish some myths about AI stocks, dividend investing, and what actually creates wealth over the long term. The first thing you need to understand about the AI stock phenomenon is that it's not just hype. There's actual reality underneath it. AI is genuinely transformative technology. It's going to reshape entire industries. The companies that are at the forefront of AI development are doing real innovative work that will probably be valuable in 5 years, 10 years, 20 years. But here's where the psychology gets tricky. When something is actually revolutionary, when the fundamental narrative about the future actually has truth to it, people don't just invest moderately. They invest with conviction. They invest with excitement. They invest with the kind of emotional energy that makes 40%, 50%, 100% returns feel not just possible, but inevitable. And that's where things get dangerous. Because once an investment narrative becomes that compelling, once enough people believe it, the stock price doesn't just reflect the company's actual value anymore. It reflects the collective belief about what that value might be someday. You can have a genuinely transformative company and still have a ridiculously overvalued stock. You can have real innovation and still have prices that have gotten ahead of reality by 5, 10, maybe even 20 years. The AI stock bubble we're seeing right now isn't happening because people are stupid. It's happening because people are extrapolating. They're looking at exponential growth curves and thinking those curves will continue exponentially forever. But here's what happens in reality. Growth rates always eventually moderate. No company grows at 200% year over year indefinitely. No technology adoption happens faster than it has time to happen. The internet was genuinely revolutionary. You could have made a fortune investing in internet stocks in 1995, but if you bought pets.com at the peak of the dot-com bubble in 1999 and held it, you lost everything. Not because the internet wasn't real, not because the technology wasn't transformative, but because the valuation had gotten so detached from reality that there was no way forward except down. And the scary part is that we're seeing eerily similar patterns with AI right now. Stocks are trading at valuations that assume they're going to maintain growth rates for 20 years that they've only maintained for 2. Investors are pricing in decades of dominance and impossible profit margins. And most importantly, they're doing it in an environment where nobody actually knows how AI will be monetized, what the actual competitive landscape will look like, or which companies will actually win. We don't know if the value will accrue to the chip makers, the software companies, the infrastructure providers, or someone we haven't thought of yet. But the market is acting like it knows. And that's the core of the illusion. Think about the hype cycle. Everyone's talking about how AI is going to replace human workers. Everyone's saying that AI is going to revolutionize every industry from healthcare to finance to manufacturing. The headlines are apocalyptic about how much change is coming. And that's probably partially true. But here's what happens to stock prices when everyone believes the same narrative. When everyone believes the same thing, you're in a bubble. When everyone believes the same thing, you get crowding. You get momentum. You get prices that are 4 times, 5 times, sometimes 10 times what the company will actually earn in the foreseeable future. That's not investing. That's speculation. That's hoping that some greater fool will pay even more than you did to take the stock off your hands. So what are dividend investors actually doing while this is happening? And why is their strategy so fundamentally different? Dividend investors have made a deliberate choice to prioritize cash flow over growth. They've said, I don't need this stock to go up 100% in 5 years. I need it to pay me reliable income while I own it. They're buying companies like AT&T, Coca-Cola, Johnson& Johnson, utilities, REITs, master limited partnerships. They're buying businesses that are mature, that have established markets, that have proven the ability to generate actual cash. And here's the thing that nobody celebrates enough. Mature, dividend-paying companies are boring because they're profitable. They're boring because they actually work. A dividend-paying stock that goes up 5% per year and pays you 4% in dividends is giving you a 9% total return. That's in the ballpark of average stock market returns. But it never makes it into social media posts. Nobody gets excited about it. Nobody films TikTok videos about it. Nobody talks about how their boring utility stock paid them another dividend payment. But that's exactly the point. The companies that pay dividends have already figured out how to make money. They've already won their market share battles. They're not growing at 200% because you can't grow at 200% when you're already enormous and your market is fully penetrated. They're instead returning cash to shareholders because they've run out of high return places to invest internally. And that's a sign of financial strength, not weakness. That's a sign of a mature, profitable business. But try explaining that to someone who just watched an AI stock they didn't buy go up 80% in 3 months. The psychology doesn't work that way. Here's something else about dividend stocks that almost nobody understands. The dividend itself is real money. It's not a stock price going up or down. It's not a paper gain that could disappear. It's actual cash that gets deposited into your brokerage account. You can spend it. You can reinvest it. You can use it to live on. That dividend from your utility company or your pharmaceutical company or your consumer staples company is as real as the paycheck from your job. Maybe more real because it's less dependent on you showing up to work every day. And over decades, reinvesting those dividends creates compound growth that is genuinely ridiculous. A dividend stock that paid you 3% in 1990 and increased that dividend by 5% per year is probably paying you 15% or 20% of your original investment cost today. That's not something you could have predicted. That's compound interest working at the dividend level. Meanwhile, the growth stock you bought in 1990 might have gone up 500% by now, which sounds better until you realize it went down 80% in 2008 and you panic sold. The dividend investor just kept collecting payments, kept reinvesting, and is now sitting pretty. The psychology of dividend investing forces you to be patient. It forces you to collect cash instead of chasing price appreciation. And that patience is the actual secret sauce that creates wealth. This is where the FOMO, the fear of missing out, becomes not just emotionally painful, but financially destructive. Here's what's happening in the minds of dividend investors right now. They made a conscious decision to be patient. They chose boring. They chose steady. They chose the equivalent of the financial equivalent of showing up to the gym every single day without skipping, eating healthy, sleeping 8 hours, doing all the fundamentally sound things that don't produce dramatic results in the short term. And then they watch someone who basically did the financial equivalent of taking steroids and doing an extreme crash diet get faster results. That person is leaner than them right now. That person looks better. That person feels like they've figured it out. And the dividend investor starts to wonder if they made the wrong choice. They start thinking maybe they should abandon their strategy. Maybe they should jump into AI stocks. Maybe they should try to chase the growth instead of farming the cash flow. And this is where the real damage happens. Because the moment they abandon their strategy based on someone else's short-term wins, they're no longer investing. They're gambling. They're chasing. They're letting emotion drive decisions that should be driven by math. What makes this particularly dangerous is that social media is a highlight reel. You're seeing the people who made money on AI stocks. You're not seeing the hundreds of thousands of people who bought Nvidia at $900 and watched it drop to 400, who bought growth stocks at the peak and got destroyed in the inevitable correction. You're not seeing the divorced accounts of people who abandoned their sensible strategy, went all in on whatever the hot narrative was, and lost everything. Those stories don't get posted on Instagram. Those stories don't make headlines. But they're happening right now. The human brain isn't designed to handle that kind of selective information bias. Your brain sees winners, sees their returns, sees their excitement, and interprets that as evidence that the strategy is good. Your brain doesn't properly weight the survivorship bias, the fact that you're only seeing the survivors who won the lottery, not the thousands who played and lost. This is why FOMO is so dangerous. It's not just that you feel bad, it's that the information environment is literally designed to make you feel like you're missing out on something real. And if you have an ounce of doubt about your strategy, if you're not 100% confident in your dividend approach, FOMO will convince you to abandon it at exactly the wrong time. Let me show you what the actual math says, because this is where things get really interesting. Let's say you're 35 years old. You've got 30 years until retirement. You've got $1,000 a month that you can invest. You can go one of two routes. Route one, you invest in AI stocks and growth stocks, looking for those big returns. Let's say you average 15% per year. That's aggressive. That's on the high end of what you might expect from a growth portfolio. Over 30 years, that $1,000 a month becomes roughly $2.4 million. That sounds incredible. Route 2, you invest in dividend stocks and blue chips, collecting that 4% yield. You get a 7% price appreciation, so 11% total return. That $1,000 a month becomes roughly the $1.5 million over 30 years. So the growth portfolio gives you roughly $1 million more. That's dramatic. But now here's what nobody calculates. What's the probability that your 15% growth portfolio actually hits 15% per year? What's the probability that you pick the right AI stocks, the ones that actually win? What's the probability that you don't panic and sell at the bottom when there's a 40% crash? Because there will be crashes. The AI stocks that triple can also have. The second thing people don't calculate is volatility. The dividend portfolio goes down 15% in bad years and maybe up 20% in good years. Your emotions stay relatively stable. The growth portfolio goes down 40% some years and up 50% others. Your emotions are on a roller coaster. How many people actually have the psychological discipline to hold through those swings? Maybe 30%. So your expected return isn't 15%? It's 15% multiplied by the probability that you actually can psychologically hold through the volatility without panic selling. For most people, that's more like 8% or 9% because they bail out at the worst possible times. Here's another calculation nobody does. Let's say you abandon your dividend portfolio and jump into AI stocks. You time it perfectly. You buy in at exactly the low point and your average return is 15% per year. But you panic once and sell at a 40% loss. That one panic moment, that one emotional decision, could wipe out 5 years of returns. So your actual return over those 30 years goes from 2.4 million to maybe 1.7 million. You just gave away $700,000 because of one bad emotional decision. Meanwhile, the boring dividend investor who never panics, who just keeps reinvesting their dividends, who never tries to time anything, ends up with their 1.5 million and doesn't have the psychological damage of having sold at the bottom. The math on actual returns is completely different from the math on theoretical returns when you account for human behavior. Here's the real risk that nobody is talking about. It's not the risk that AI stocks will crash, although they will at some point. It's not the risk that you'll pick the wrong ones, although you will. The real risk is called opportunity cost, and it's absolutely devastating when you understand it. Let's say you have $100,000 right now. You can invest it in dividend stocks. Getting 4% yield plus 3% appreciation equals 7% total return. Or you can invest in AI stocks expecting 15% returns. Over 5 years at 7% annual return, your $100,000 becomes about $140,000. At 15%, it becomes about 200,000. That's a $60,000 difference. But here's where it gets dark. What if you do neither? What if you leave that 100,000 in a savings account earning 0.5%? You end up with about 102,500. You lost $37,500 compared to dividends, and you lost $97,500 compared to AI stocks. But most people's real choice isn't between growth and dividends. It's between dividends and doing nothing. And even if dividends seem boring compared to AI, they beat the pants off doing nothing. They beat cash. They beat bonds. They beat the financial illiteracy that has most people's money sitting in savings accounts earning nothing. The other risk that AI hype is creating is something called concentration risk. When everyone believes in one narrative, when everyone's money is flowing toward one sector, when everyone's convinced that AI is the future and everything else is outdated, you're looking at a situation where billions of dollars are chasing a handful of companies. That concentration is what creates the bubbles. That concentration is what creates the crashes. When AI stocks are flying up 80% per year and everyone's talking about how the old economy is dead, that's when concentration risk is at its absolute maximum. Dividend stocks are more boring precisely because they're diversified. You've got your energy, your utilities, your healthcare, your consumer staples, your real estate. Your money is spread across dozens of sectors and hundreds of companies. If one sector tanks, you've got others holding you up. And that diversification, that boring stability, is actually one of the smartest things you can do to build wealth without taking catastrophic risks. The wealthy people who got truly wealthy and stay wealthy, they're not the ones who made one incredible bet on AI stocks. They're the ones who diversified, who had multiple income streams, who weren't putting all their eggs in the basket of one technology that might or might not deliver on its promises. So how do you actually build wealth while everyone around you is chasing AI? How do you stay sane while watching people make 150% returns on stocks you don't own? The first thing you do is remember that you can't control stock prices. You can't control what happens tomorrow in the market. You can only control your behavior. You can only control your savings rate, your investment strategy, and your discipline to stick with it. The people who get destroyed by AI hype are the ones who abandon their plan. They're the ones who had a dividend strategy, got FOMO, moved everything to AI stocks at the peak, watched it crash, and locked in losses. That's not a failure of the strategy, that's a failure of discipline. The people who make money are the ones who have a plan and stick to it through multiple market cycles. They're the ones who invest the same amount every single month regardless of whether stocks are up or down. They're the ones who understand that volatility is your friend when you're consistently buying. Because crashes are just sales where everything costs less. They're the ones who can hear about AI stocks going up 100% and not panic. Because they understand that their boring dividend strategy is printing reliable wealth month after month, year after year. The second thing is to remember that boring wins. Over the last 100 years, the average stock market return is about 10% per year. Some years it's up 30%, some years it's down 30%. But over full market cycles, over decades, the simple, boring strategy of buying and holding diversified index funds of both growth and dividend stocks beats the pants off trying to time the market or chase the hottest narrative. The people who bought IBM in 1980, thinking it would be the future forever lost to people who bought a boring index fund. The people who bought Cisco in 2000, thinking it would dominate the internet, lost to people who bought a boring index fund. And the people who are buying NVIDIA today, thinking it will be the centerpiece of their wealth 20 years from now, are probably going to lose to people who own boring, diversified portfolios. Not because NVIDIA won't be valuable, but because they've priced in so much perfection, so much future growth, that there's no room left for surprise gains. The good news is, if you're a dividend investor, you're already doing the thing that works. You're already executing the strategy that has the best historical track record. You're already positioning yourself to win over the long term. You're just not winning in a way that's exciting enough to post about on social media. Look, I'm not saying you should never own growth stocks. I'm not saying you should never take on concentrated risk. What I'm saying is that the AI hype is real, but the AI stock hype is a separate thing. The hype is a psychological phenomenon that's disconnected from reality. And if you can recognize that hype for what it is, if you can see that people making incredible returns in the short term are usually being rewarded for taking on risk, not for superior intelligence or foresight, then you can stay focused on what actually builds wealth. You stay focused on your plan. You stay disciplined with your investments. You remember that compound interest is patient. You remember that boring is better than exciting. You remember that the dividend stocks you own are printing cash, building value, and setting you up for financial independence, whether anyone on social media is talking about them or not. If you want to beat inflation, if you want to build real purchasing power, if you want to actually achieve financial independence instead of just daydreaming about it, dividends are still doing that work. The AI narrative might be the sexier story, but the dividend story is the one that actually pays the bills. The dividend story is the one that's been paying the bills for 100 years. The dividend investor sitting quietly in the background, reinvesting their distributions, collecting their checks, not panicking during downturns, is building real wealth. That wealth might not be as exciting to talk about at parties. That wealth might not get likes on social media, but that wealth is real. That wealth is secured. That wealth compounds. And in 20 years, 30 years, when the AI hype has faded into something normal, when the spectacular returns have become regular returns, when the excitement has died down, the dividend investor will be the one still standing with a portfolio that's grown quietly but relentlessly. Don't let FOMO destroy your strategy. Don't abandon what works for what's exciting. The AI stocks might go up more. The dividend stocks will go up more reliably. Make sure to like this video and subscribe to this channel if you want more content that cuts through the noise and shows you what actually builds wealth.